and Warsh is about to begin. But there's a constant battle over whether we're going to rally and basically devalue the currency and go into a hyperinflationary crash up on the stock market, or a deflationary bust crash down in the stock market. And the example I like to give is in 2019 in Venezuela, the Venezuelan stock market was the best performing stock market in the world. It had 10,000% returns month over month the entire year. Well, that's amazing. The only problem is that the Venezuelan stock market wasn't going up, it was the currency going down. The currency, the Venezuelan bolivar, was losing 10,000% of its buying power month over month over month. And it took 10,000% more bolivar to buy the same amount of the Venezuelan stock market month over month over month. And that's what is at risk when we're going into these type of hyperinflationary environments. And we have sprung the trap of that hyperinflationary crash up, which is essentially the collapse of the US dollar in real terms. And it's a confusing subject because we weren't taught it in school, and it's by design. Right now, Trump is in China, and they are basically splitting up the world, or their perception of their rights to the world resources. And it's going to be interesting to see how all of this works out. But the subject I want to touch on right now is the fact that after the Federal Reserve cuts interest rates, there is a very reliable pattern inside of the broad markets after the cut. And you can see all of these little red ovals here. Those are rate cuts. Those are rate cuts. Now, the perception that Wall Street, retail traders have is that the beginning of rate cuts is bullish. It's because of the initial rally that happens after the Federal Reserve announces rate cuts. The reality is that every single one of these pivots has put in a top of a market. And so what happens is retail chases a narrative that isn't true. Wall Street sells into that liquidity and takes their exit stage right. And it repeats over and over and over again. The Fed pivot in 2007 led to a 50% crash. It took 18 months. The Fed pivot in December of 2000, the stock market crashed 38.3%. It took 21 months to recover. In 1989, the pivot, the market only crashed 4.4%. It took 16 months to recover. June of 1981, the stock market crashed 16.5%. It took 13 months to recover. In 1973, the stock market fell 41.3%. It took 11 months to recover. In March of 1970, the stock market fell 18.9%. It took 3 months to recover. It took 3 months to bottom. And over. And we've done this study back into the 1940s. And you can see here, pivot, 5.9% rally. Took 1 month for stocks to fall 4.4%. 1960, Fed pivot, 24% rally. It took 24 months to fall 3.8%. Fed pivot, March of 1970. This was a little one, 5.8% rally. Took 3 months to fall 18.9%. This is a pivot in 1973, initial rally, 6.6%. This stream continues at eMoneyAddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.